We've created a monster. And to be honest, we had no idea what would come out of this at the start. Built from 12 separate parts. An arm here, a leg there, a beating heart. Each part on its own, nothing special. But something happens when you combine them, something we can barely explain ourselves. And then after weeks of testing, it happened. It's alive, and it's not just alive, it's immortal. We're shocked ourselves at the power that suddenly stands on the screen. Let's go. Disclaimer. Quick heads up. Yes, I'm an AI avatar. Trading Swarm is our English channel. The German original is Kaspareit Trading. We've now made the entire system available in English. The same portfolios, the same approach. As always, this is not investment advice. Trading involves risk. Only trade money you can afford to lose. The seemingly perfect strategy. Imagine someone shows you this equity curve. It rises almost like it was drawn with a ruler. Barely any drawdown, barely any bad phases. A strategy that seemingly does everything right, plus a win rate of 78%, a profit factor of 2.8, a Sharpe ratio above 2. Numbers most people would jump on immediately. And this is exactly where the mistake happens, because what you just saw is in sample, highly optimized on historical data. The moment we let the strategy loose on unseen data, the picture looks completely different. The curve that just seemed like a promise breaks down. That's exactly the problem with chasing the one strategy. It tempts you to keep optimizing until the backtest looks perfect. And as soon as real market data hits, everything falls apart. So we eventually asked ourselves a different question. Even honest single strategies aren't enough. Even if you do it right, even if your strategy is properly walk-forward tested and works in reality. Even then, there are phases where it just doesn't earn anything. A trend-following strategy makes money in strong trends. But as soon as the market goes sideways, like we saw for a long stretch in 2022, it loses. A mean reversion strategy works in ranging markets. In strong trends, it runs into trouble. Every strategy depends on a specific market phase. And no market phase lasts forever. That's exactly the point where we stopped looking for the perfect strategy. The real idea, diversification. Ray Dalio, one of the most successful investors in history, called it the holy grail of investing, but not the way most people search for it. The exact opposite, in fact. The idea is simple. Take two strategies, each only mediocre on its own. Neither is spectacular. Both have drawdowns. Both have weak phases. But, and this is the key, they have their weak phases at different times. When strategy A is struggling, strategy B is making money, and vice versa. The losses of one are cushioned by the gains of the other. The result is a curve that runs much smoother than either of the individual strategies. The maximum drawdown is lower. The progression is more even. We took this exact principle to the extreme. We started collecting parts, an arm here, a leg there, a beating heart. Each part nothing special on its own. Some looked unremarkable, some even off-putting. But we knew, the single part isn't the goal, the interplay is. That's the point. It's not the individual strategy that makes the difference, it's how little it correlates with the others. Portfolio L. If two mediocre strategies already do this much, imagine what 12 can do. 12 strategies, each tested individually, each solid on its own, but none perfect. Spread across 6 different markets, Forex, indices, and commodities. That's exactly what Portfolio L is. 12 strategies, 12 parts, assembled into a creature that didn't exist before. Trend following is the muscle that grips when the market runs. Mean reversion is the breath that stays calm when markets swing back and forth. Seasonalities and volatility strategies are the nervous system that reacts to specific stimuli. Each part has its job. None would be viable alone. The result? A net profit of over $19,000 on just $10,000 starting capital, a maximum drawdown of only 5.27%, a Sharpe ratio of 2.46, and that's across a time frame from 2020 to today, through all kinds of market phases. Even in out of sample, meaning on completely unseen data from 2026, the portfolio stayed in profit, despite all the uncertainty in global markets this year. But we wanted to know for sure. So Portfolio L has been running in a live beta on a demo account for a while now. We closed out the first beta with a gain of 4.52%. We're currently in the middle of the second BEYTA and also in profit as of today at plus 3.73%. By the way, Portfolio S is also running in parallel in its second BEYTA and is currently at plus 1.19%. None of these strategies is perfect on its own, but combined, they're hard to beat. Let's look at this more closely. When we run each of the 12 strategies individually over the same period, this is what we see. Some bring 4 or 5%, others 10, 15, some even over 20. Each one on its own would be nothing worth making a video about, and now comes the part that opened our eyes. The individual drawdowns. Some strategies have drops of 2 or 3%, others are much higher. Strategy 10, for example, hits a drawdown of almost 10% on its own. That's one of the wildest parts we built in. Would you trade that strategy in isolation? Probably not. But as part of the whole, this wild part becomes one of the strongest pillars. But now the crazy part. When you combine these 12 strategies, the gains add up. But the drawdowns, they don't add up. On the contrary, they compensate for each other. While one strategy is struggling, another is earning. The result, the entire portfolio has a maximum drawdown of only 5.27%, less than some individual strategies on their own. That's the supernatural power of anti-correlation, the magic of immortality. And the craziest thing about this monster isn't just the power, it's the fact that it can't die. We built it to survive every market crash, every sideways phase. Even the harshest crashes of recent years didn't bring it to its knees. Whether normal correction or black swan, the portfolio lives on. How did we do that? Walk forward analysis, Monte Carlo simulation, out of sample on data the portfolio has never seen. We put it through every test we could think of. And it's still alive, because no single part can kill the monster. The construct carries itself. If you want the details, check out our recent videos. We've shown the entire development process step by step. And if you haven't subscribed to the channel yet, do it now. We're putting out new content every week on portfolios, strategy development, and automated trading. This robustness is the real magic. It's the reason this monster is immortal. The resolution. And I'm proud to say it this clearly. What we've built here is in fact a monster, assembled from parts that no one wanted on their own. But together, they unleash a power we barely thought possible, and a robustness that makes it immortal. And now the part we can hardly wait for. On June 8th, our monster gets unleashed. From that day on, Portfolio L runs no longer in demo, but with real capital on our own account. If you want to be there when this monster moves real money for the first time, you'll find Portfolio L in our Trading Swarm Premium membership, currently at $649 a year. But I'll be honest with you, this price will go up over the course of the year. Whoever joins now locks in the current rate permanently, as long as the membership stays active. The link is in the description. If you have any questions, drop them in the comments. Our team and the community will jump in. See you next time.